fabulous speaker who I have had the pleasure in the last few shows hearing his strategies, and certainly watch him on CNBC. He'll be speaking at the SALT conference over at the Bellagio. He is a dynamic speaker, and you will love laughing with him. He's also a great friend. Peter Schiff was a staunch advocate for investing globally before diversification and profit, long before this strategy gained popularity on Wall Street. A visionary in the field of investments, Peter is a CEO of Euro Capital, Pacific Capital, Inc., and Euro Pacific Precious Metals, LLC. He is an internationally recognized economist specializing in foreign equity, currency, and global markets. Peter frequently delivers lectures at major economic and investment conferences and is quoted often in the print media, including the Wall Street Journal, New York Times, LA Times and Barron's, Business Week, Time, Fortune, and on and on. His broadcast credits include hosting his daily radio show, The Peter Schiff Show, along with regular guest appearances on CNBC, Fox, CNN, and MSNBC. Peter is the author of a number of best-selling books, including The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. Can we have Christmas first? Peter's fifth book, The Real Crash, fully revised and updated, America's Coming Bankruptcy, was released April of 2014. Peter correctly called the current bear market before it began and positioned his clients accordingly. He is an expert on money, economic theory, and international investing. Recently, Peter warned investors about the clear and present danger that is stalking the global economy. Peter and his beautiful wife, Lauren McCord, last year became proud parents of an adorable baby boy. I just saw pictures. He is precious, and I was delighted to go to dinner with him in London, where he was so well behaved. And I understand there is another one on the way. I know. Congratulations. So please extend a warm, warm welcome to the Money Show to Peter Schiff. Thank you.
Thanks, Kim. All right, so I found out I only have 20 minutes here today, and if you heard me speak before, normally after 20 minutes I'm just getting warmed up. So, as you know, Paul Harvey used to say, if you want the rest of the story, I am doing a workshop at 11:15 tomorrow, I think right next door. So I will finish wherever they cut me off. I'll finish it up tomorrow. If you look at the conventional wisdom right now with respect to the U.S. economy and the markets, I don't think I've ever seen it more wrong. I mean, it's normally wrong, but not by this much. And the theory is, or what people's view is, that we're recovering, right? We had this brush with death years ago. We had this financial crisis, but thank God for Ben Bernanke and now his protege, Janet Yellen. The Fed saved the day, and we're finally seeing the payback, right? We're finally getting this long-anticipated economic recovery that they promised us 5 years ago when they began this experiment. And the markets are going up, the real estate market is back, the stock market is back, the U.S. economy is back, everything is great. The Fed's going to remove the training wheels, it's going to taper the quantitative easing, they're eventually going to raise interest rates, and everything is great. The problem is that is complete fantasy. None of that is going to happen. There is no economic recovery in the United States at all. There is no evidence of an economic recovery. The U.S. economy is in far worse shape than it was on the eve of the 2008 financial crisis. We've never been in as worse shape as we are right now. But they say, whoa, but the stock market went up. Yeah, of course the stock market went up. You print enough money, you can make the stock market go up. Yes, the Federal Reserve succeeded in reflating the stock market bubble, but that's all that it did. It doesn't evidence a strong economy. Look, stock prices went up from 2002 to 2007. Did that mean we had a sound economy? No. We were on the verge of a complete implosion. The main difference, though, between the stock market bubble that we have today and the one that blew up, let's say, in 2000, is that fewer individuals are participating. This is the bubble for the 1%. This is the hedge funds, the private equity guys. You know, Kim mentioned that the Dow and the S&P are at record highs, and I think they are, just barely. I mean, we're barely positive on the year, but the S&P, or the NASDAQ, I believe, is negative, and the Russell 2000 is. But more importantly, I think half the stocks in the Russell 2000 are down more than 10% on the year. But the overwhelming concentration of buyers are very wealthy people. The average American is not participating in the stock market to the extent that he was in the 1990s. And so the Fed is not getting the boost to consumption that you would normally have from the wealth effect, because a lot of people aren't feeling the effects of the wealth because they don't own stocks. The same thing is happening in the real estate bubble, which the Fed has managed to reflate. The difference, again, between the real estate bubble we have now and the real estate bubble that popped in 2007 is, again, the average American isn't participating. Home ownership rates are at 19-year lows. You have hedge funds and private equity companies that are buying up real estate. Last month, I think 43% of all the properties purchased in America were purchased for cash. These are not typical Americans buying houses to live in. These are investors buying houses to flip, buying houses to rent out. This is not a healthy market. It is an extremely speculative real estate market, thanks to the Federal Reserve. So the Federal Reserve has managed to reflate two bubbles simultaneously. And of course, the biggest bubble of them all is the bubble in the bond market. So we have an entire economy that is supported on a foundation of bubbles. And Janet Yellen testified just last week in front of Congress, and she was asked point blank, do you see any bubbles? And her answer was no. Well, her answer would always be no. There has never been a Fed that acknowledged, yeah, it's a bubble. They always say there's no bubble. Why even bother asking? Because they're never going to acknowledge it. When you ask somebody from the Fed, well, what do you think is going to happen in the economy? They're always optimistic. They never say, I think there's a recession coming. The Fed has never seen a recession. It only acknowledges it in hindsight. Now, there's maybe a couple of reasons for that. One might be they're actually dumb enough to believe that what they're doing is going to work, right? You have the Fed stimulating the economy, and so they expect the stimulus to be successful. They don't understand that the stimulus is toxic, that what they're doing to the economy is actually preventing it from recovering. So they expect a recovery, so they build that bias into their forecast. But I think what's more important than that is, even if the Fed believed a recession was coming, they would never admit it, because they don't want to cause it. They're afraid that if they're pessimistic, if they actually say, I think the economy is going to turn down, that businesses will, adjust their behavior. Maybe they won't hire people they were planning on hiring. Maybe they won't make a capital expenditure they were planning on, because the Fed just delivered the bad news. So the Fed always wants to be optimistic. The Fed always wants to talk the economy up. That's why they're always wrong. That's why they're always more optimistic than the facts point out. Look at what happened to the first quarter of 2014. Everybody on Wall Street and the Fed were looking for GDP growth in Q1 upwards of 3%. That's what everybody was looking for. What did we end up with? 0.1. And that's before the next revision, because most of the Wall Street firms now expect the Fed, as normal, to downwardly revise the first quarter GDP. And they're looking for now minus 0.6, minus 0.8. And all of this, of course, is if you buy the idea that annualized inflation in the United States is only 1.3%. I don't believe that for a second. So I think if the Federal Reserve used, or if the Labor Department used a more accurate inflation number to deflate nominal GDP, it was a much bigger negative number than what they're going to end up reporting. But the fact is, they're going to report negative GDP, a contraction. That means we're halfway to a recession right now. Now, everybody is telling us, well, don't worry about the first quarter, because it was the result of the weather. The weather. It was cold in January and February, and that's why the economy contracted. Yeah, it was too cold. Businessmen couldn't hire anybody because it was just too cold. There was too much snow. You know, apparently, there was a lot of snow. This was the 10th snowiest winter in the last 50 years. That doesn't sound that bad. 10th snowiest? That means every 5 years we've had a winter with more snow than the one that we just had. Yet those other periods didn't, you know, take the economy into negative territory. You know, they said, well, Americans, it was too cold. Americans couldn't shop. They were snowed in. They couldn't get out of their houses. Yeah, but they had the internet. How do you explain soft online sales? I mean, wouldn't online sales be better if you're snowed in? Wouldn't you just shop on the internet? You know, they blamed the slowdown in auto sales. GM and Chrysler had big slowdowns in their auto sales. They said, yeah, Americans, they couldn't get to the showrooms because there was so much snow. But BMW and Mercedes had record sales this winter. How was that? How is it that wealthy people had no problem braving the snow, but average Americans who wanted to buy a pickup truck, no, it's too cold for them? I don't think any of the weakness in the first quarter was related to the weather. I mean, for all I know, the weather padded the GDP in the first quarter, because GDP just measures spending. How do we know people didn't spend more because of the cold weather? More on utilities, more on snow removal? Who knows? I mean, we don't know where the economy would have been, but everybody is conveniently blaming it all on the weather. So we don't have to worry about all the bad economic data because none of it counts because it was cold. See, I think what is more significant than the cold weather was the Fed. See, what did the Fed start doing at the beginning of the year? It started to taper the amount of stimulus, the amount of monetary heroin it was putting into the economy. And so what happens if you're a drug addict and you're not getting as much drugs as you're used to, right? You start to have withdrawal. Even though you're still getting drugs, you need more. You've built up a big tolerance because you're used to so much. And so I think what's happening isn't the cold weather, it's the fact that the Fed is not providing as much support to the markets as it was. And that's really all the economy has, is the markets. You know, when the Federal Reserve, when Ben Bernanke, before he left and started us on this course of taper, the reason that he said that he felt confident enough to do it was because of the wealth effect on the economy that resulted from the stock market going up and the real estate market going up. He's actually proud that he was able to reflate these bubbles, even though he doesn't realize they're bubbles. But he says that because we have the strong markets, we're going to have all this spending and we're going to have a recovery. The problem is you take away the QE and the markets will implode, because the only thing that is propping them up is the cheap money. It's not earnings that is driving the stock market. It's cheap money. And people will talk about, well, but look at all the cash, right? Corporations have a record amount of cash. Yeah, they do. But where'd they get it? They didn't earn it. They borrowed the money. They have record amounts of debt. And the only reason that it's manageable is because interest rates are so low. The same thing for the housing market. What's keeping the housing market propped up? Where are the institutions that are paying all cash for these properties getting a lot of the money? It's being borrowed. Just because you don't have a mortgage doesn't mean you didn't take on debt. A lot of this money is being financed by debt. It's just not the mortgage market. But the cheap money is flowing, and that is what is driving the asset bubbles, even as the real economy is imploding. Look at the jobs numbers that we just got last week for March. And the headlines, this is great, right? The unemployment rate is all the way down to 6.3%. We created 288,000 jobs. This is proof that we have this economic recovery. Well, why did the unemployment rate go down to 6.3%? Is it because people got jobs? No. Over 800,000 people left the labor force. They're gone. That's why the unemployment rate went down. The economy is imploding. We have the lowest labor force participation rate since 1978. And that actually is not really an apples-to-apples comparison, because that's when women were first entering the labor force in the 1970s. Because before the 1970s, they didn't have to work. because their husbands can afford to support them. But due to the inflation and the expansion of government from the 1960s that continued in the 70s, they didn't have that luxury. Women now had to work because that was the only way to pay the bills. But if you look at labor force participation among men, it's at an all-time record low. I mean, there's nothing that comes close to what's going on right now. Meanwhile, yeah, we created some jobs, but people under 55 actually lost jobs. We created jobs for older people. Why are older people getting jobs? Because they can't afford to stay retired. You've got people in their 60s and 70s coming out of retirement to work at McDonald's. A lot of these jobs that we're creating, the vast majority of these jobs are service sector, low-paying, part-time, temporary jobs. They're not replacing the jobs that were lost. Productive jobs were destroyed, and these mixed jobs are being created as the labor force is contracting. The real economy is getting smaller. It's not getting bigger. Right? Yeah, the stock market's up or the real estate market is up, but that reflects the bad monetary policy. It doesn't reflect good economics. But where are we now? Right? The Fed is trying to take away the supports that have been propping up the economy, and you have people on Wall Street blindly believing that somehow the bubbles can sustain themselves without the air, or that the U.S. economy or the markets can survive higher interest rates when they can't. It is impossible. Now, think about where we are in the market. This is May. We've just gone through the seasonally strong period of the market. This is normally the market makes the biggest move up early in the year, right? Sell in May and go away. They have that saying for a reason, because there's usually a lot of gains by the time you hit May. We don't have any gains. A lot of people have losses in the U.S. stock market, and we're coming in to the seasonally weak period of the year. Now, what do I think is going to happen? Over the next several months, we're going to continue to get economic data that disappoints. That's going to be the headline that you're going to hear over and over again. You know, disappointingly, unexpectedly weak, unexpectedly low, because this fantasy of recovery is going to fade, and the excuse to blame everything on the weather is going to go away. Now, maybe the Fed, Janet Yellen, is going to be able to taper a couple more times. I mean, right now they're doing $45 billion a month of QE, down from 85, and it's actually more than that because they're reinvesting principal and they're reinvesting interest. So it's a bigger number, but that's the official number is 45. Maybe they'll get down to 35, maybe they get down to 25, but at some point the Federal Reserve is going to have to admit that once again they were overly optimistic on their assessment of the U.S. economy. Because as the recovery that everybody has been, conditioned to believe is coming, as people realize it's not here, right, I think you're going to see a pickup in unemployment. I think you're going to see companies that might have hired some people anticipating a recovery when they realize it's not here, laying some people off. I think the stock markets are going to continue to trend lower, certainly beneath the surface, waiting for the Fed to come in and admit that it was wrong. And when it does that, it's going to, I guess, the first thing it will do is announce a halt to the taper, a pause. Right? There'll be a meeting where the Fed says, we're not going to taper that additional $10 billion. We're going to wait, and we're going to see what's going to happen. And that, eventually, I think what they're going to do is they're going to have to reverse course, and they're going to end up doing even more QE, that the Fed is going to ramp it up so that they're doing more than the $85 billion a month that they originally started from. Not because it works. It doesn't work. But it's because that's the only thing that the Fed knows how to do, right, is create inflation. And of course now they've got us conditioned. They're trying to tell us that the only thing we have to worry about is that there's not enough inflation. They used to talk about deflation. Now they're talking about lowflation, right? That if prices aren't rising fast enough, that's also a problem. Realize, I mean, the only thing deflating in the United States is the average American standard of living. I mean, Kim had those charts, and prices are rising, and they're going to rise even faster. But when the Fed has to admit that it was wrong, I think that's a game changer in the markets, because what drove the dollar, what propelled the dollar higher in 2013, what forced gold down in the second half of 2013 was the belief that you have a self-perpetuating recovery where the Fed is going to be able to raise interest rates and stop the stimulus. When the market has to digest a different scenario, one in which the U.S. economy is back in recession and where the Fed is going to have to back up the truck and do even more QE than it did before, that is a game changer. Now you've got to reassess your prospects for the dollar. And by the way, just last week, until the ECB threw the dollar a life raft, the dollar hit a 5-year low against the pound, a 4-year low against the New Zealand dollar, a 3-year low against the Swiss franc. It was about to break down against the euro when Draghi came in and said, okay, we're going to print a bunch of euros, right? And that, temporarily caused the dollar to rise, but the dollar is still near its record lows. The dollar index is still below 80, even though everybody is still incorrectly anticipating a stronger U.S. economy and a tighter Fed. When they realize that the Fed's going to do more QE and that the U.S. economy is a lot weaker, then I think the bottom really drops out of the dollar, and I think you're going to see the dollar fall through and trade, below 70 and 60s or something, lower than that. And when that happens, that's also a game changer for gold, because gold sold off because of the anticipation of a tighter Fed. That is impossible. It's 5 years into the so-called economic recovery, and interest rates are still at zero. If the economy were recovering, that wouldn't be the case. It's like you're in a hospital bed and the doctor tells you you're just fine, but you're still plugged into all kinds of tubes. And he's like, you can't take any of these tubes out. The reason that interest rates are still at zero is because zero is the most we can afford. We can't pay any more than that. The government has all this debt. So when our creditors figure this out, and why they haven't figured it out already is amazing, but when the Fed has to come back after all these years and admit that what they did didn't work, and now they've got to do more QE. And of course, it's been so long since the last recession, we're statistically due for another one. Normally the Fed would already have raised interest rates considerably, 5 years after the end of the previous recession. But the Fed has still got them not only at zero, but they're still doing QE. So I think what's going to happen is when the Fed has to acknowledge this, and you get a game changer, you get this big event where the dollar breaks down, commodities break out, gold breaks out. Now, what is the Federal Reserve going to do? Because now it's going to be in a real box. Because it has two choices, neither of which are good. See, the first one is the Fed is going to have to let interest rates go up. The Fed is going to have to raise interest rates substantially to stop the dollar from falling, to stop inflation from getting out of control. And what happens when the Fed does that? Well, the stock market collapses, the real estate market collapses, right? A lot of the too big to fail banks fail. They're not going to be able to survive an increase in interest rates. And the problem is when these too big to fail banks fail, their depositors lose money. Because you have to realize, if the Fed's out of the game, if the Fed is tightening, they can't bail out anybody. The Fed has to be easing in order for the federal government to bail out anybody. So if the Fed is tightening because it has to fight inflation, then if the bank fails, it fails. If the depositors lose money, they've lost their money. There is no money for the bailouts. So that's one case, that's one scenario. The Fed does the right thing and we have a complete collapse. If the Fed is afraid of that, right, if it's afraid of doing the right thing because it doesn't want to deal with the consequences, then what does it do? Then it's going to have to really kick quantitative easing up into a whole new gear. Right now it's going to have to buy even more bonds. It's going to have to print even more dollars that nobody wants to buy the bonds that nobody else will buy. And then that really increases. The process accelerates. Right? Because now you've got the potential for runaway inflation. And once people figure this out, once they see, right, that the Fed can't fight inflation, they always talk about it, right? You'll always hear the Fed say, look, if we want more inflation, but if it gets out of hand, I mean, if it's too much above 2%, then we have the tools to fight it. No, they don't. I mean, they have them, but they can't use them, because if they did, the whole economy would implode. Because everything that's been created as a result of their policy is phony. The only way we could have had a real recovery would have been if the Fed allowed a real recession. They would have had to allow the continual, deflation in real estate prices, in the stock market. They would have had to allow the U.S. economy to restructure. They would have had to raise interest rates so we could have had more savings and more production. The Fed didn't do any of that. All the Fed did is try to find a quick fix to get us through another election cycle or two, and all they did was reflate the very bubbles that had already blown up. Right? They didn't learn anything from their prior mistakes. They just decided we need to do more of it. Right? We need to repeat what failed because that's all we can do. Yet, you had so many players, right, believe it. I remember, I was on CNBC with Mark Haynes, who's no longer with us, and I was talking to him about the stock market, about the real estate bubble. And this was probably in 2005. I was talking about it. And he said to me, Peter, do you expect us to believe that so soon after the bursting of the NASDAQ bubble, we have a real estate bubble? I mean, these things happen once in a lifetime, once every 50 or 100 years. Are you expecting us to believe that we'll have two bubbles less than 10 years apart? Is that what you're expecting us to believe? And I said, yeah. I said, it's the same bubble, and people have very short memories. This is how short they are. All the people who lived through and invested through the technology bubble of 1990s and the real estate bubble of the following decade, they're still around. It's the same people, yet they haven't learned anything, including the people at the Federal Reserve. Janet Yellen, when they appointed her, right, they tried to convince us that Janet Yellen was the one person at the Fed, right, the one person, who saw the crisis coming in real estate, that was warning about the financial crisis, that was warning about the housing bubble. No, she wasn't. The only time she mentioned the warnings about the housing bubble was to dismiss them. She reassured everybody that there was no housing bubble, and she said as late as 2006 that even if housing prices went down, something that she did not expect to happen, that it wouldn't matter because it wouldn't hurt the economy because real estate was a small part of it. So it's still the blind leading the blind, and what you have to understand is the conventional voices are never going to warn you about what's going to happen. They don't understand it, or if they do, they're never going to admit it because they have a vested interest in keeping their mouths shut. But what I'm doing is trying to tell you what's actually going on in the U.S. economy, what's actually going on with the markets, what's going to happen with the dollar, what's going to happen in the bond market, and I think it's going to be very significant. In fact, I think 2013 in many ways reminds me of the market in 1999. And if you recall how the markets did 2000 and even through 2008, adjusted for inflation, adjusted for the decline in the value of the dollar, that was very substantial. It was a very rough period for investors. And this time around, it's going to get even worse. And it's even more important that you be prepared. And we'll be discussing exactly what you need to do at the workshop tomorrow.